Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager here at Schwab, and this is Getting Started with Thinkorswim. And today, we're going to be tackling what may be one of the most powerful tools on Thinkorswim, but also, in my view, one of the most misunderstood. It does have a bit of a learning curve. It's known as the Analyze tab on Thinkorswim. Carries a whole suite of tools, and we're going to be spending most of our time on what's known as the Risk Profile tool and that Analyze tab. It's been my experience that once it's understood, it becomes sort of an option trader's best friend. Go ahead and chat in and let me know if you're familiar with this risk profile tool and if you use it regularly just in maybe the preparation of your practice trades or whatever. But we're going to get into the specifics of how we're going to tackle this presentation in just a moment. But before I do that, let me first of all say hello to everybody out there in YouTube land. Great to see our live audience members chatting in. Hello there, Will and John, David, Krishna, Eva, Scott, Joe, everybody else. Thanks for joining us week after week. We really do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation, but be aware that you're invited to join us in a live discussion. This is a Wednesday webcast series, and it kicks off promptly at 2 o'clock Eastern. If you'd like to join us in the live stream, we'd love to have you here. I also want to let you know that my very good friend Kevin Horner is going to be hanging out in the chats with the live stream attendees. Kevin's going to be addressing any questions that I can't get to as long as they're on topic. Thanks for having my back there, Kevin. And Kevin and I would also like to issue an invitation to you all to follow us on X. If you're not doing that, that's a great resource. It's the best place for us to connect with our audience. It's the best place to find your presenters in between the live streams. So you can find Kevin on X at Kevin Horner CS. You can find me there at Cameron May CS. So give us a follow there. It doesn't cost anything to follow. And again, great educational resources there. But let's get into this. And as we dive in, of course, we need to first of all consider the risks associated with investing. Risks are real. They certainly apply to options trading and to, I think that's related to this discussion. So bear these disclosures in mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Options carry a high level of risk and are not suitable for all investors. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right, so let me take a look at what our attendees are saying about this tool. David's saying it's a super tool. John says, I haven't used it. Life in the Fast Lane says it's a great tool. Eva says, I'm familiar with it. Do I use it? Rarely. Yeah, it's not going to apply to everyone, but just as a quick overview of what this tool delivers potentially to a trader, there are so many different strategies out there under the umbrella of options trading. And whether you're looking at them in isolation or combination with other strategies that are being applied, it can quickly get kind of heady to try to figure out what's the profit potential or the loss potential on a trade or a group of trades. And the risk profile tool actually delivers a chart that can just display that for the trader at a glance. So we need to learn about it, but it has some potentially powerful applications. So what we're going to do today is we're going to build a hypothetical options trade. I'm going to lean a little bit on the assumption that this discussion is for options traders, so that I'm going to assume that people know what I'm talking about if they're watching this to learn about options trading tools. Yeah, we're going to build a basic trade, and then we're going to look at it through the risk profile lens and start to play around with all of the tools on that risk profile. So let's go to it. Risk profile is housed on the Analyze tab on Thinkorswim on the desktop trading platform. But here's going to be our example trade today. Let's say that our hypothetical trader is taking a look at Bank of America. They notice it's had a nice run, recently consolidated into what might be called a symmetrical triangle, which to some might be an indication that the established upward trend is likely to continue. And then they also notice that price has popped out of that triangle. Maybe they think that price is likely to go higher, or at least stay above the breakout point at about $46. Okay, that's a basic premise of our trade. This is going to be a bullish trade. And let's say that our trader has decided, as a consequence of their technical assumptions for Bank of America, they're going to go trade some options. And specifically what we'll do today, let's put on a long call vertical spread, also known as a bull call spread. So that consists of buying a call and selling a call. So we're going to go to our Analyze tab. Look at that. My habit is typically to go to show you how to place a trade. I'm going to go to the Trade tab. But the Analyze tab actually contains a feature within it that looks almost identical to the Trade tab. As a matter of fact, let's go to the Trade tab, and we see here if we have Bank of America queued up, we have our options chain down below. Well, if I go to the Analyze tab and I start on the Add Simulated Trades, and we make sure that we have the same symbol, we also have the options chain. This tool, Add Simulated Trades, functions very much like, it overlaps to a very high extent with that Trade tab. And you might think, well, why do we need the redundant functionalities? Well, the Add Simulated Trade is actually directly tied to the risk profile. So we're going to build our trade using the Add Simulated Trades tab. Let's just go down here to the 21st of February. Let's assume that our trader is thinking, well, Bank of America is likely to be above, $46 for the next 37 days. So how about we do, let me change our spread from vertical back to single for just a moment. Maybe our trader is eyeballing buying the $45 call and selling the $46 call to create their bull call vertical spread. That just gives them the right to buy shares at 45, obligates them to potentially have to sell those shares at 46, which would result in a $1 profit if this were a free trade. It's not going to be a free trade. It's probably going to wind up costing us 75-ish cents to set this up. In any case, Jim says earnings tomorrow on Bank of America. That's great, Jim. That's a possibility. Some traders don't mind trading over earnings. Others avoid it. For the purposes of this discussion, since it's a tool demonstration, not a big deal. But let's go ahead and place our vertical spread here. So I'm going to come up here to Spread Single, and notice this works just like on the Trade tab. Let's change that to vertical and find our two strikes that we are interested in, and then click on the ask price to create that vertical spread. Now, as I close up my option chain, I can look down below. It's a little bit compressed. Let me click on the little margin here and drag up here. As I drag that up, you'll see this has created more space at the bottom, and kind of tucked away down there at the bottom is this example trade to buy the one call, sell the other call, creating the vertical spread. And how about we just lock this in? Let's click on the lock here to make sure that the anticipated cost of this debit spread doesn't change while we go and use the risk profile tool to start to sort of take it apart, see what kind of potential it has. Now, for those of you who trade vertical spreads, you might look at this and say it's a dollar wide spread, it's a 75-cent debit, so there's a 75-cent potential loss. Through the 21st of February, a 25-cent potential gain. All of that might already be going on in a trader's mind, but it can also just be helpful if we have a chart that displays all of that. So once we've built a trade on the Add Simulated Trades, the trader can then just skip right over to this risk profile tool. And just as the name implies, this is showing us the potential risk of the trade at expiration, as well as the potential for reward of the trade at expiration. So the first thing I want to turn our attention to is this yellow line. Now, I've customized the colors on my screen. If yours happens to be red or purple or whatever, doesn't matter, but the Z-shaped line, or this sort of roughly S-shaped line, is the one that we'll be looking at first. And what this is doing is showing us an intersection of potential profit levels with possible price levels on the stock. So right now, our Bank of America, the stock, is trading at $47.31. That's what this vertical dashed line represents. It's just a visual benchmark to show us where we are right now. And what this orange or yellow line shows us is the potential for profit or loss at expiration of this contract, 21st of February, if price goes up or down. So over here is that potential for loss or gain. And you can see for this trade, it's not going above $100 because this trade actually doesn't offer the potential to make more than $100. As a matter of fact, as I just mentioned, if we spend 75 cents on a $1 wide vertical spread on a debit spread like this, how much is left over for profit? $25. Well, interestingly, if we come up here to the top line you'll notice that this levels out at about $25. And if we do some squinting here, let me point just at this line and leave my cursor here. And what I want you to do is, as I'm pointing at this, look down here. Look down here at this number in yellow. So I'm going to point at that line. You'll see the number in yellow is February 22nd, day after expiration. This is telling us, hey, Cameron, if you are at any of these prices, $47, $48, $49, $50, $51, whatever, if we're up at these levels, the profit on this trade at expiration is $25. So that's what this horizontal line means. Okay. Wiming Shi says, how do we get this screen in Thinkorswim? So if you just arrived, you may need to go back and watch the recording of this webcast. This one is scheduled to be added to the YouTube playlist for this webcast series afterward. But this is the Thinkorswim desktop trading software platform. If you're not familiar with that, it can be downloaded free of charge from your Schwab Online account. Just go to the Trade tab there, and you can download this. But I showed how to get to this screen once one is logged into our Thinkorswim. Okay, but in any case, this is showing us how much the trade can make at expiration beyond the 21st of February, or at the 21st of February. How much can it lose? Oh, if we just follow this orange line down, it bottoms out down here. And as I point at this, so this is at levels at 45, 44, 43, 42. If we're at any of these price levels at expiration, we can see the number over here now shows minus $75. Yeah. So for each contract on this trade, should the trader choose to place it, they can make up to $25 if the stock is above the spread, above the $46 strike. They can lose down to $75 if the stock is below the spread, below $45 at expiration. So what about this? What about this in between here? Oh, and Eva says there's a survey. Fantastic. I know it's early in the webcast already, so people don't really have opinions about how it went just yet. But if everybody who's watching the live stream right now could do me this favor, click on that survey link. That'll activate the survey. Then you can fill it out after the webcast is over, and give me some honest feedback. But I just want to let you know a couple of things about that survey. It's a short survey, 2 multiple choice questions. So it could just be click, click, done, send it off. Or there's also a comments box and a suggestion box. You can fill that out to give me some more specific information. But in any case, I always say, if you take the time to fill out that survey, I promise you I'll take the time to read through the data. I read through the comments. It's always helpful. So thanks for doing that. Definitely fill out that survey for me if you would after the webcast is over. So, Bob says Brent teaches that the top window should be set to the day after expiration. The bottom should be set to the current date. Your thoughts? Good question, Bob. We're going to be talking about these dates here and here in just a moment. But for right now, we're just focusing on this orange line, which actually didn't require any customizations to this chart at all. It just automatically pops up this way when we build our trade and add simulated trades, and we pop over to risk profile. But what is this portion of our orange line? Well, this is showing us that if we wind up somewhere in between the strikes at expiration, well, then we're not at maximum loss, we're not at maximum gain, so we must be either a little bit short of being, maybe we have a bit of a profit, just not all of it, or we have a bit of a loss, just not all of it. Yeah, that's what this is showing us. So let's say we were to wind up at, $45.50-ish at expiration. Well, that's telling me, as I point at this, I can look over here and see what my potential gain or loss is. Let's do that. Let's go to $45.50. And that's showing me that we have, at that point, at expiration, this trade would be unprofitable to the tune of $25. Matter of fact, there's a break-even point. You can see this red hash mark is showing us this is where the trade would break even at expiration. This is where we would neither make money nor lose money. It's a zero outcome. And that's because we've fallen short of our max gain, but we haven't fallen so short that we're starting to dip into loss territory. So how is that calculated? Well, if we have 25 cents that we can make on a vertical spread, if we're above 45, then every penny that we're short of 45, we're giving away some of that 25 cents down to a break-even point of $45.75. That's where this hash mark is positioned. So all of this can be quite useful for a trader. Maybe they've conjured up some multi-leg strategy. They don't know what the profit or loss scenario is going to be. They don't know where it would make its money, where it would lose its money, where's the break-even point. Just build the trade in the add simulated trades and then come over to the risk profile, and it shows us how much the trade can make. It shows us how much the trade can lose, and it can also show us how much or where the trade can break even. Now, that's this orange line. What is this blue line? Again, color schemes can be different on different traders' platforms. I've changed these to blue and orange. So if it looks different on yours, that's okay. But with this more curved, sloped line, this is showing us how this trade is performing as of today. So the assumption of the orange line is that we're at expiration. Notice the blue line is dated 1/15. Today is January 15th of 2025. So this is showing us a profit or loss curve potential for this trade as of today. So we can start to ask ourselves questions. Well, if we're at $47.27 right now on Bank of America, and the stock starts to go up, what's that going to do for this bullish trade? Well, it's going to start making money for us. It's not going to get us up to maximum gain right away, though. So let's say the stock were to pop up to $49. I can just intersect my price assumption with my profit assumption. Let me point at $49, and then look down here at the blue number, and it gives us a projected profit. Let's put that back at $49. That looks like if we were to pop up to 49 today, about a $9.86 unrealized gain on that trade. What if the stock were to fall today? Well, let's say we drop down to 46 bucks. Now we look at that little blue number, and it shows this trade would be off to kind of a rough start. We'd probably be sitting on about a $14.25 loss. So that's the purpose of this blue line. It shows us how the trade might be performing on dates other than expiration, starting with the current day. So now to go to a portion of Bob's suggestion. Bob, I'll get to the other one. I think it was Bob. Yeah, Bob says we might adjust these dates. Let's come down here to where it says January 15th. That determines the date here. And if we start to change that date, what it changes is the profit and loss projections for future dates. So let's say instead of being January 15th, let's push this out to a week from now. Let's change this to January 22nd. And our blue line has changed very subtly. As a matter of fact, if I did that a single day at a time, keep your eye on the blue line as I advance the date one day at a time from January 15th to the 22nd. What you'll notice is, and probably the easiest thing to track, is this break-even point, because there's such a subtle change in the slope of our line here. But you'll see that break-even point is moving, or if you focus on the distance between the expiration profit and the date profit, watch this. Let me dial it back in time. And if I dial it forward in time, what you'll see is that the profit and loss scenario changes over time. And what it does is it moves closer and closer to just being just like the profit and loss scenario at expiration. I think that just makes sense. But what the trader can start to do here is explore possibilities. Hey, if I did this trade and then the stock moved up a certain price by a certain date, how would the trade be performing at that point? Or if I did this trade and the stock fell to a certain price by a certain date, how would the trade be doing at that point? So let me just pause there. January 23rd, kind of a random date between now and the expiration in February. But our trader can now just say, well, what if our stock popped up to $49 here? Well, now instead of being up maybe $9.85, we're up $11.75. Or if we slip down to 46 bucks, now instead of being down $14, I think is what it was before. I can't remember now. Maybe it was 11. I can't remember. But in any case, it's showing us the loss potential of the trade on that date. So yeah, what the trader can do here if they just like to see profit or loss for today, they can default to today's date, just like Bob proposed. Or if they have a question about a future date, they can choose that future date anytime between now and the expiration of the planned trade. So pretty nifty. If we were to just keep advancing this, what you'll see is that it just keeps, I'm just keeping my finger down, clicking on the plus button here. You'll see that it keeps forming closer and closer and closer. The risk profile really starts to look very much like the expiration profile, especially, you know, in this case, we're 1 day from expiration. And then when we get to expiration, the two lines overlap precisely because here we are, we're at expiration. So nifty little function right there. And this is probably the tool that is most commonly used, or the way the tool is most commonly used for some traders when they're initially using this tool. But we're going to be going a little bit deeper than that. Next thing I want to get into are the other lines on the chart. We have these vertical dashed lines. I already told you what this one means. That's the current price of our stock. What are these other two lines? Well, these are prices, and they're called price slices because they kind of slice the chart into quarters. You know, there's a quarter over here, there's a quarter here, and a quarter here with these three slices. So they're kind of slicing down through the chart. Well, the slice off to the left can also be described numerically. If we click on price slices over here, you can see here's our current price slice, 47.26. It's in the middle. The slice off to the left is at 42.53. That's here. That's an assumption that price falls 10%. And the slice off to the right is an assumption that price rises 10%. So it just starts with the current price and assumes a move up or a move down. And then it gives us all of this other data showing us how our trade would likely perform if the stock were to move that amount up or down. So right now, our trade is basically a break even. If it were to move up 10% right away, we'd be looking at maybe a $21 profit. If it were to drop 10% right away, we'd be looking at maybe a $49 loss. So we can start to see the numbers displayed here differently. But we can also play with these slices. So, for example, we can come over here to where we have our little action menu. Anytime on Thinkorswim you see 3 dashes and 3 dots, that's a menu item that allows us, it's a menu that allows us to make changes to our chart. So for example, you might be wondering, why is this saying, you know, why is it setting our base price plus or minus 10%? Is there something else I could do? Yeah, one common thing that's done by traders is we can go to break even. Maybe the trader likes to see where that break even point is on their chart. It just draws that price slice right there. Now we can change the price slices using this menu. Let's switch it back to base plus and minus 10%, or we can start to move the slices manually. So, Bob, I'm going to go to your other question. I'm kind of mentally rearranging the way I was planning this presentation because you asked a good question. You made reference to this date up here. And Bob says maybe this should be set to the expiration. So the expiration on this trade, let me drag this margin up a little bit so that we can see our trade down here. If there's not enough space down below, if we're looking at the price slices, the trade can kind of disappear off the bottom of the screen. So we can borrow some of the space that we're using for our chart just to bring that trade back into view by moving this margin up or down. So let me just put it right back where I had it. There we go. But what in the world is this date, and how does it relate? Because it does relate to this number. Well, what this date is showing us is a probability range right here, this gray field right there. Specifically, what it's doing is it's saying, Cameron, there's about a 68% chance that the price is going to settle somewhere in this gray area by this date, or on this date, more specifically. About a 68% chance that just the way this stock moves, it's probably going to land somewhere in here. So there's roughly about a 16% chance it might wind up further up here, about a 16% chance it might wind up further down there. Well, what Bob has passed along as a suggestion from another presenter named Brent, maybe we change this date so that it matches our expiration on our contracts. Let me click on this. I'm going to push this out to the 22nd of February. And it's saying now, well, there's about a 68% chance that given another month, obviously the stock can travel further, but there's about a 68% chance that we land somewhere in this range, right? So there's a good chance that we might wind up here at maximum gain. There's also a good chance we might wind up down here under maximum gain, break even, or even down in max loss territory. So that's what the gray area represents. Another thing, though, that might be of interest for our traders is they might be looking at this expiration wondering, well, let's get more specific than that. What's the likelihood that our trade actually winds up in max gain territory? In this case, we need our trade to be above $46 to be at maximum gain. Well, that's when these numbers come into play. Watch what I can do here. I'm going to click on this slice, the one that's just set to the current price, and I can drag it over and position it right at $46. Now I can get that pretty close. Notice this is like 46, 06, 05, 04, 03, 02, 01. A little bit finicky to do it that way. Another thing that I can do, let me just I'm going to put it right there. Let's say I did my best job, but I still wound up at 46.17. Another way I can move that slice is just to change its value down here. Let's type in $46 right there, and you notice that moved that slice right to my upper strike price. So now I can look at price levels above that and look at the associated percentage likelihoods of those price levels, and I can now see with some good precision, there's about a 49% chance that we're going to wind up between 46 and about 52. Additionally, there's about a 13% chance that we're going to wind up somewhere above 52 on the 22nd of February. So if we add those up, the trader can see a good mathematical estimation about a 62% likelihood of maximum gain on this trade. You like that, Bob? Is that explaining why Brent might set this up here? It helps us with these percentages. That's why he suggested that we set this to the expiration. We can see what the probabilities are at expiration. Obviously, if the trader wanted to see probabilities on some other date, they would choose some other date here. Now, by the way, I didn't mention, why is it 68%? 68% has broad application in fields like engineering and math. It's one standard deviation. That's why it's 68% there. Now, the trader might also be curious to know, well, what's the likelihood of at least breaking even? Well, if I need to be at 46 or higher, which carries a pretty strong likelihood, well, just breaking even doesn't even require that I'm at 46. We know that we need to be at 45.75. So let's just go ahead and change this to 45.75. And that skips our middle slice, right, 45.75. And I can see the probabilities went up just a little bit more. We went from a combined 62% probability of making maximum theoretical gain on this trade to a combined about 64% probability, 64.5%, of at least breaking even on this trade. So I can just do the opposite math. We must be around 35% probability, 35.5% probability that we're going to wind up below break even. And if I want to see the likelihood here, I could look at these numbers and combine those. If I want to see the likelihood of maximum loss on this trade, I could just change this here. Let's just take off the 75 cents. Likelihood of maximum loss, about 11 plus 17, 28%. Now, if you just did the math, Frankie's asking about time decay. Yep, Frankie, I said I kind of mixed up the order. in which I'm delivering this webcast. I'd actually planned to cover that time decay element a little bit earlier, but Bob asked the question. It was on topic. I thought, great, let's talk about that. We'll come back right to that, though, Frankie, okay? But if I do my math correctly, if there's a 65% chance, no, 62%, 62% chance of maximum gain, and there's about what, an 18% chance, maybe a 19% chance of maximum loss, that's only like 70, no, it's about 80%, right? Maybe 81%. Where's the missing 21%? Well, that is the likelihood that we don't get maximum loss, we're not at maximum gain, we're somewhere in between. So how about we use a couple of these slices? I'm just going to do this. Let's drag this one over to 46. I'm going to put it right at 46. Let's grab that one and drag that one over to 45. And my math must have been off. Anyway, yeah, 29% chance of maximum loss. Yep, that was probably just my fault for doing it in my head and not just using the numbers here. About a 29% chance of maximum loss, about a 62% chance of maximum gain up here, leaving over about 9% that we're somewhere in the middle. As we're going through all of this, what I hope you're seeing is what a powerful tool this is and all the nifty little features the trader can go through and really customize their view of the risk and reward and the probabilities of a trade. Now, going back to Frankie's question here, we know price can be an important determinant of success or failure on an option trade. But it's not the only determinant. Time is a determinant. And actually, Frankie, time we've built into this the trading assumption when we change the date down here. It's actually the time decay that changes the profit and loss reward potential of the trade. Let me talk about that. Let's come back up here. I'm going to show you a feature right up here. If I come up here and I click on reset, that's going to reset this whole chart right back to where it was before we started tinkering with it. So now we're just back to looking at this at the profit and loss, the original. We're back at the original expiration. And I want to talk about the impact of time. So with this 45-46 bull call spread, the stock needs to be above $46 at expiration for this to work out optimally. For it to be in position to make its maximum theoretical gain, we need to be above $46. Well, where's the stock right now as we speak? It's already above $47. So the stock is already where it needs to be. And as long as it doesn't go the wrong way, what happens a day from now with the potential for profit or loss on this trade? Well, this trade has time working in its favor. As long as the stock is where it needs to be, the closer we can get to expiration, the more and more confident we can feel that, hey, we're going to wind up above 46 bucks. So if we click on the plus sign, we can see time actually working in the favor of this trade, even without the stock moving. You know, if we just look right at, let me just reset this back to the present day. There we go. If we look at present day, we're below break even due to the spread in the bid and ask price on the options that we've traded. So break even is right here. But if we advance time, where's that break even going? It's moving toward the current price. It's reducing the loss on our trade and actually can start to move us into profit territory just because of the passage of time, even though our price isn't moving. So yeah, this is how the time element is built into our trade performance assumptions. Now, we haven't accounted for everything though. We can look at price here. We can look at time here and adjust the date here. I'm going to come right down here to the little gear down in the lower right, click on that, And this now allows us to make some additional assumptions for our trade. First of all, we can change the stock price. If we change the stock price, what do we suppose is like, let's set this back. I'm going to click here, reset. Another reset function exists right here under this menu. I'm going to reset the parameters of this trade. There we go. Just sets us back to January 15th. In any case, let's now keep an eye on the performance of this trade. If we're starting off at $47.23, we're a little bit underwater on this trade. Now let's start to assume that our stock price starts to go up. Let's say we go from $47.22 up to $47 and who knows, 75 cents. Let me just enter that in here. And what you'll notice is the trade assumption here, the profit or loss since we opened the trade, has gone from a loss of $2 to a gain of $2. So this is starting to show us how our trade would likely perform if our stock price starts to go up. And we can keep clicking the plus sign to keep dialing that up, and you'll see the profit scenario for our trade going up. It's also showing us the profit or loss if we were to go up 10% right there, up or down 10%. So we can, the trader can examine how the trade is likely to perform by changing price here rather than just looking at it up here. But importantly, we can also change volatility assumptions for our trade. So this is known as a long call vertical spread. Typically, when we buy options, if volatility goes up, what does that do for the value of options? Increased volatility typically increases the value of options, which is good for buyers, it's not good for sellers. If volatility drops, that's bad for buyers and theoretically good for sellers. So this net being a purchase trade, this is a debit transaction. If we start to assume volatility rises, let's just say that traders think, oh, the markets are likely to get choppier. Maybe Bank of America is going to start moving around more. We can adjust volatility up. But I'm going to click on that volatility number. And it's starting to, and I want to say it's kind of nice that a trader can look at the potential for profit or loss on an individual trade. As fans say, they want to make that trade. It can be a single leg trade. It can be a vertical spread with 2 legs. It can be an iron condor with 4 legs. We can put in a custom strategy with all kinds of numbers of legs. And this will draw for us a profit and loss line for today, for future dates. We can manipulate price, time, and volatility. All those things can be done, but we can also do it to analyze an entire portfolio. Within this paper money account, we actually already have 4 existing positions. So if we were analyzing this trade and we wanted to add in those other 4 positions and just see, how might this whole portfolio perform all together as markets move. I'm going to come right here where it says single symbol. So it's just looking at Bank of America right now. I'm going to click on that and change that portfolio to portfolio beta weighted. And then the final adjustment I'm going to make is I select that as I change that to portfolio beta weighted, I'm going to benchmark that against, and this just is an example, it could be, we could use a different index as a benchmark, but let's change this to the S&P 500. And notice that our profit and loss scenarios have changed drastically. So now we're seeing where the S&P 500 is right now, and we're seeing a profit or loss line for the first expiration in all of our positions if the S&P were to go up. We can also see if it were to go down. This is the anticipated performance of an entire portfolio based on the S&P rising or falling. And of course, we could change that to other dates as well. Frankie, you like that? Yeah. So this is where the trader might use the tool to examine, I wonder how my whole portfolio is structured. If a trader were to show this chart to me, and I could just say, okay, it looks like we're benchmarked against the S&P 500, we're looking at the entire portfolio, You don't need to tell me anything about that portfolio, but I can tell you between now and January 18th, this portfolio is bullish. Net. I don't care what it's constructed of. This is a bullish portfolio for the next little bit. Andrew says, will this presentation be archived? Yes. Yep. Not unless there's some unanticipated technical glitch or I said something so offensive that it has to be binned, which I hopefully never do. Yeah. This one is scheduled to be, it is being recorded and scheduled to be archived to our YouTube channel, so you can go back and revisit this. But everybody, that's it. We've done what we wanted to do today. I've introduced you to the Analyze tab. We've added a simulated trade. We've broken that thing into all of its component parts for profit or loss scenarios on the risk profile tool. As you can see, it's a powerful tool. Of course, there's a learning curve to it. So what you might want to do is go to your paper money and just experiment with this tool a little bit. Paper money is a no risk environment. Can't actually lose any money in there. So it's a good place to learn new tools and new techniques. But it's time for me to let you go enjoy the rest of your day. But as you do, just remember you have other resources outside of today's discussion. One thing that I would definitely recommend is that you subscribe to our Trader Talks channel on YouTube. I was just asked if this is going to be archived. Yes. Where do we find those archives? On the Trader Talks channel on YouTube. Go to the playlists on our homepage. That's where you can find all of our playlists for previous webcasts. You can also join the live streams right here, and you can do searches for specific topics of interest. If you wanted to learn a little bit more about the Analyze tab, if you want to see it through, demonstrated by somebody else, just come here, search for Analyze, and you'll see some other discussions. Or you might look for risk profile, you might look for options, whatever the area of interest is. Nicole says, going back to the option volatility piece, how do we come up with a volatility estimate? That's probably a discussion for that's a question for another discussion, Nicole, because it's fairly deep, and I don't have time, the luxury of time to give that its due right now. It's a good question though. We'll talk about volatility in future webcasts, especially in my options oriented webcasts. If you'd like to join me there. But another resource that you should definitely be availing yourselves of, it doesn't cost anything to subscribe to our Trader Talks channel, by the way. So go down and click on subscribe right now. But also, it doesn't cost anything to follow us on X. X is the very best place to connect with your favorite presenters in between the live streams. As a net resource, live streams for each presenter, relatively rare resource. I'm only on these things for about 4 hours a week. Best place to connect with me in between is on X. So you can find Kevin on X at Kevin Horner CS. You can find me there at Cameron May CS. Just give us a follow, and we'd love to see you there on that platform as well. But everybody, thanks for giving me the thumbs up. I already see 40 of you have done that. That's fabulous. Thanks for always clicking on that like button if you've enjoyed a webcast. It's a pat on the back to the presenter, and it gives their webcast a boost in the YouTube algorithm, helps them find a wider audience. Last opportunity to fill out that survey. So if you do this for me, if you didn't previously click on that survey link, click on it now, and then just give me that honest feedback, and I'll read through it. Definitely appreciate it. All right, everybody, go enjoy the rest of your day. I'll look for you in a future webcast. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.